Planning for succession, the first steps. Hello, I'm Melissa McLean, accredited financial planner with IG Wealth Management. For 17 years, I have been working with clients and small businesses in the financial services field, and for the past 10 of those years, I have been a financial planner working with high net worth clients and businesses, focusing on implementing personalized strategies to help them achieve their financial goals. When it comes to small businesses, their goals of being successful and putting everything into the business changes when they start to think about no longer running it. It quickly becomes a little bit stressful, not only because they will be leaving something that they worked so hard to build, but how to transition the business and to who. There are many different business structures: sole proprietor, partnership, and corporation. Some of those you may not need to consider some of the steps or planning that is relayed here. However, I felt that it was important to share as much information as I could for a more broad-based audience. Regardless of what structure you are in, it is important to know that selling your business typically takes 1 to 2 years, the process from start to finish. Some things to consider. Will you want to be employed by the business to assist with the transition? This can be advantageous to both the current business owner and the prospective business owner. However, it may not be what one of the parties would like. If it is decided that the previous owner will stay on, how will they be paid? There are multiple options to review in this scenario, such as an annual salary that is paid out for a certain amount of years, or it will be built into the cost negotiated or the price negotiated on the sale of the business. These are just two of the examples. Considerations. Will the business be transitioned to family? We will discuss this further later on in this segment. Are you selling the entire business or just a portion? Perhaps you are looking just to sell the physical location of the business, or you are looking to enter into a partnership. Another consideration is, do you qualify for the capital gains exemption deduction? The current lifetime capital gains exemption deduction, or the LCGE, is $970,000. This is for 2023. If you are in a partnership, for example, this amount may be used for each of the partners, but only in specific scenarios. Business succession takes a lot of pre-planning, not just internally, but with some external partners as well, such as your lawyer, your accountant, and your financial consultant. These experts will be able to guide you towards the most seamless and cost-efficient to provide you with the most accurate advice that you will require to make informed decisions. Some of the required documentation that you will need for your lawyer, accountant, and financial consultant will allow them to be able to provide you with accurate and detailed guidance and advice, and some of those are the following. An organizational chart or an org chart. This outlines key principles and the hierarchy of the company. It may also briefly describe the roles and responsibilities of the individuals in the company. The org chart should and would have the shareholders listed and the percentage of the shares of the company that they each hold. This will be an important piece of information that potential buyers of the company will be interested in for multiple reasons, including talent retention. An up-to-date shareholders agreement is also a required document. This is to ensure that all the shareholders are treated fairly and that their rights as well as the business's rights are protected. It outlines the obligations of all the shareholders, how the shares will be issued, the decision-making process, and how the shareholders will be paid when the company is sold. It is also to include a section of how the shares will be handled in the event of a retirement or a death of a shareholder. There may also be a buy-sell agreement. Another required document would be the latest 2 years of company financials. These will be used to determine a proper valuation of your company. Once this is determined, you will have a price that you can set for the sale of your business. There are many factors when considering the valuation of a company, such as cash inflows, outflows, expenses, depreciation of equipment, consumer need, ownership of property, etc. Insurance policy documentation would be any policies of any life, disability, and critical illness that the company has on any of its shareholders and key persons to protect them in the event of death, short-term illness or injury, and long-term illness or injury. You should include detail as to who has what insurance and for what protection. All personal insurance protection should be provided as well to allow your experts to be able to plan accordingly in the event of death, short or long-term illness or injury, during or after the sale of the business. Wills and powers of attorneys are crucial documents for estate planning, and there may be a dual will involved for the business assets. Dual wills can be used as a tax strategy for business owners to allow for better planning around estate administration tax, better known as probate. Once all this information is collected, your team of experts can be able to begin the initial planning, determine a valuation for your business. A business appraiser may be brought in for this, evaluate any gaps that may exist, and determine best outcomes for the flow of business proceeds. This step can take anywhere from several weeks to months, depending on if all the information has been provided or if more is required, how organized the financials are, and if any tax planning or filing is up to date, and how large the business is, and the reports that need to be reviewed. When all the information has been reviewed and all experts have come together to formulate the best structure for the sale of the business, now is the time to find a buyer. This is where I would like to talk about if the business succession plan involves a family member. There can be many advantages to transitioning your business to family, including family legacy, avoiding to have to find a buyer for your business, potentially less tax payable, the possibility of continued involvement. Those are just a few. However, it is important to consider the following when transitioning your business to family. In the event that your child or children are purchasing the business, are there other children that are not? This can be a very complex question with potentially several layers. For example, if you have multiple children but only one is purchasing the business, it may not be complicated at first. However, what if you pass prior to the business being fully purchased? To add more complexity, what if there is a blended family scenario? This is where a revision of your will may need to be considered, and this is only one example. There could be many different scenarios that should be reviewed for your specific family. Your accountant and lawyer should be involved with ensuring your wishes for legacy and equalization are all taken into consideration and implemented. Ensuring you are getting fair market value, or FMV, for the business. When evaluating the business and what the government will be reviewing in terms of taxes owed for the sale, fair market value is a good starting place for determining the purchase price. Depending on the family relationship, gifting some of the business, its equipment, property, shares, etc. may be considered. It is always important to consult your accountant and lawyer on these gifting options and if they work for your particular situation. Enforcement action for proper and timely payments to be made. If the sale of the business states that the purchase payments will occur over a determined amount of time, how will those payments be made? If there is a default, how will these be handled? This may be an agreement that occurs whether the business was sold to a third party or a family member. In the case of family members and a default happens, this could create some animosity among the family dynamic. Documented business plan. Documenting where the current status of the business is and where it wants to be in the future. Outlining the roles and responsibilities going forward will assist in eliminating any confusion going forward, as well as overstepping any boundaries under the new ownership. Although not all conflicts or situations are able to be identified, there should be a resolution process put into place to allow these instances to be dealt with fairly and quickly and not disrupt business as usual. If the business is being sold to a third party, many of the previous considerations would be applicable, including ensuring you are getting fair market value, enforcement actions for proper and timely payments, and a documented business plan. A non-disclosure or confidentiality agreement would be another important document that should be signed prior to any information provided to potential buyers. This protects the business's confidential and/or proprietary information. This document can also aid in not having any key persons in the business unaware of the potential sale of the business become concerned and seek out other employment opportunities. A business broker is also another invaluable team member for your business sale for you to consider adding. A business broker specializes in and would assist in the following: business evaluation, finding qualified buyers that have been pre-approved for financing the sale, negotiating with prospective purchasers, and the due diligence process and filing any paperwork required.